Okay, so I'm live on YouTube also, so students can join in there. So friends, can we proceed now? So we are having how many more questions to do? We are having 3A, 3B is a theory-based problem, which I'm doing it in the, this is a new theory, friends, which I'll be doing it in the Saturday session. 4A we have, 4B. 4B is exactly similar to what we did earlier, friends. Then you have a valuation question. And then we have a question on future, AIC generic swap, certainty equivalent approach. We have some very good questions, friends, but most of these, if you observe, we have already covered, friends, because we have done study material in so much in depth that major areas are all covered. So it's easy for all of you to actually revise and do it yourself. Let us do question number 3A. 3A is a beautiful question. This question might take around 30 minutes, friends. First thing, they have told X is having 4 lakhs. He can invest in 3 alternatives. Alternative 1 is put full money in A, put full money in B, that's option 2. And option 3 is, what I'll do is, first we need to analyze the options. So I'll call it as options over here. Option 1, option 2, and then we have option number 3. Option 1, what are we going to do? Full in A. So I will say over here, 100% you're going to invest in A. What about option 2? 100% in B. Now tell me, what is option 3? 2 lakh 40 means 60% will go in A and remaining 40% will go in B. All right. They have given you the returns of security A and B is 15% and 14%. RF is given as 10%. RM is given as 12%. So let's put that in the basic data. So I'll write down over here. Working note number 1. Basic data. I'll write point number A. Okay, return of A is 15%. Return of A is 15%. Then you have return of B. How much is return of B? 14%. All right. Then you have standard deviation. RF is how much? 10% is your RF. And they have given RM. RM is how much percentage? 12% is your RM. All right. Down they have given you a table. So this table we have learned in a method called as the matrix method, friends. I hope you remember that. So
Yes,
working
sir.
note number 2, analysis of matrix. Analysis of matrix. So you have security A, B, C, A, B, and then you have C. So I will just put 4.8, 4.3, 3.37. Again, you have 4.3 over here, 4.25. What is the next one? 2.80, 3.37. Then you have 2.8. Then you have 3.1. So friends, let me decode this matrix here itself. AA means what? It is variance of A. Everybody clear? So the variance of A is turning out to be how much? 4.8. Same way, variance of B will be how much? 4.25. And variance of C will be 3.1. From this, can I also find out standard deviation A, standard deviation B, and standard deviation C? I will get the number as 2.19. 2.06 and 1.76. Then I can also go and find out covariance AB, covariance BC, and covariance of AC. So covariance AB is going to be 4.3. Covariance of BC is going to be 2.80, and covariance AC will be 3.37. This is the data that is available from the matrix. All right. Yes. Once we get this, they're asking you to calculate the expected return of security A, security B, and of the portfolio. Okay, so I'll write down here expected return. So I can get this for option 1, 100% in A only. If I put 100% in A, what is the return that I'm going to get for A over here? Do you get the answer as 15%? What about option number 2? You're putting your money only in B. So that is 14%. Then I will have option number 3. What is option number 3? 15 will have a 60% probability and 14 will have a 40% probability. So 15 into zero point 0.6, 14 into 0 0.4. Do I get the answer as 14.60% over here, friends? These are the expected return. Or what is the formula for expected return? Weighted average, outcome into probability. Everybody clear with this part? Okay. Now, let's go to the next requirement. So once you get this, second, they're asking you to find out the variance of security A, security B, and variance of the market. Okay, friends, I think one correction I need over here. This is not variance of C. C is actually market. So we'll call it as M. A, B, and then you have M. So it will be covariance of BM. And here you'll have covariance of AM. Covariance of AM. Variance of C, we'll call it as variance of M. And standard deviation of M. All right. So that's the market, basically what they have given. So friends, that's already found out. We got the variance of A also here. We got the variance of, we got the variance of A here. Okay, we got the variance of B here. We got the variance of the market. We also got the covariance. So whatever they are asking over here has already been found out by us. Then they are asking the variance and standard deviation of the portfolio. So I'll write down next working note. Standard deviation of the portfolio. So how do I find out the standard deviation of the portfolio? I can use Markowitz method. Okay. So here I will use standard deviation of A, that is 2.19. 2.19 into 0.6 the whole square plus standard deviation of B is 2.06. 2.06 into 0.4 the whole square plus 2 into 2.19 into 2.06 into 0.6 into 0.4 into correlation. All right. Friends, in order to find out correlation of AB, what will I do? I will take covariance of AB, that is given over here as 4.3, covariance of AB divided by standard deviation of A into standard deviation of B. So this and this will automatically get cancelled. So now tell me what is the answer you get over here? 2.19 into 0.6 the whole square will be plus 0.6789. 2 into 0.6 into 0.4 into 4.3, that is 2.064 the whole square root. Do you get the answer? Square root of 4.4694. Correct? So you will get the answer as how much? 2.11. That will be your combined risk of the portfolio. So we did it using what method now, friends? We did it using Markowitz method. All right. So friends, we are done with this one particular area also. Shall I go to the next requirement now? So they need the variance of the portfolio also. So therefore, what will be the variance of the portfolio? That will be this square. That will be 4.469. Everybody clear with this part now? Okay. Next one. Let us go to the next part now. So then they are asking you to calculate systematic and unsystematic risk of security A, B, and portfolio. Okay. Fine. So I'll write down the next working note heading. Option 1. What is option 1? 100% in A. So here I'll do step number 1. We will first find out non-diversifiable risk of A. What is the formula for calculating non-diversifiable risk of A? Standard deviation of the market into beta of A. Now tell me, have they given the beta anywhere over here? No, beta is not given. So how do I find out beta? So I think even before this, I should work out the beta first, correct? So tell me, I'll put the formula number 3 for beta. So I will write down beta. So I'll use beta of A will be covariance of AM divided by variance of M. I think that's a logical answer. Covariance of AM. A with that of the market, that is 3.37. Divided by variance of M is 3.1. So what is the beta you get over here? Do you get the answer as 1.087? Now tell me, beta of B. That is covariance of BM divided by variance of the market. So covariance of BM will be 2.8 divided by 3.1. Do you get the answer as 0.903? Now tell me what will be beta of C. That will be, oh, there is no beta of C. Sorry, there's only A and B. C is nothing but the market. So once you get beta of A with that of the market and you get beta of B with the market, we can go and solve it now. So I'll write down the next working note heading. Okay. Option 1, analysis of risk. So here we'll find out 3 types of risk. Step number 1 will be total risk of A. So when you're putting 100% in A, the total risk of A we already found out over here, it is 2.19. Okay. Step number 2, non-diversifiable risk of A. How do you find out that? Beta of A into standard deviation of the market. Or in other words, how much is beta of A? 1.087 into standard deviation of the market we found out in the first part, 1.76. So what is the answer you will get? Do you get the answer as 1.91312? Correct? Therefore, step number 3 will be what? Diversifiable risk of A. That will be the square root of total risk of A minus square minus 1.91312. Am I right? So I think 2.19 square is directly given over here. That is 4.8. It will be the square root of 4.8 minus 91312. It will be 3.66. Do you get the answer as square root of 1.14? That will be equal to 1.06. So friends, we have done option 1. We got the total risk, non-diversifiable risk and diversifiable risk. Now in the same way, I will now do what? I will do option number 2. What are we doing in option number 2? We are investing 100% in B. So now here again, I will go through the steps. Step number 1 is going to be what? Total risk of B. So total risk of B we already found out in one of the earlier working notes, 2.06. 2.06. Okay, then I'll write down step number 2. NDR of B will be beta of B into standard deviation of the market. So how much is a beta of B? You got it over here, 0.903. 0.903 into standard deviation of the market. That will be how much is the standard? 1.76 to 1.76. Do you get the answer as 1.589 over here? Correct? So now I will write down step number 3, diversifiable risk of B. So how do you find out the diversifiable risk of B? I will take the total variance minus the non-diversifiable variance. So 2.06 square will be nothing but 4.25 square root of minus 2.524. Okay. So you'll get the answer as 1.588. Is everybody clear with this part? Friends, one more thing I had to find out here. I found out beta of A, I found out beta of B. I need to find out the beta of the portfolio also. How do you find out the beta of the portfolio? 1.087 will be into 0.6 and 0.903 will be into 0.4. So you'll get the answer as 1.0134 as the beta of the portfolio. Everybody clear with this part now? Okay, so now I have got total risk of option 1, total risk of option 2 we have done. Now I will write down the next working note heading. Total diversifiable and of option
Excuse me, sir.
number 3. Yes, tell me.
I think the last working diversifiable risk of B, that value, I think
1.31, sir.
Have I made a mistake over here?
last step.
4.5 minus 2.524. 1.726 square root is 1.31. Thank you for correcting me. I don't know how I got that number. 1.31. Thank you so much. So I think you're done with this. So total risk, diversifiable risk, and non-diversifiable option number 3. So in that, I'll write down step number 1, my total risk. This we have already found out using Markowitz method. 4.469. That is 4.469. Step number 2 is going to be what? Non-diversifiable risk. That will be beta overall into standard deviation of the market. So how much is beta overall? How much is beta overall? We found out somewhere over here, right? It's 1.0134. That will be 1.0134 into standard deviation of the market. 1.76. Do you get the answer as 1.7835 as the non-diversifiable risk? Therefore, your diversifiable risk will be 4.469 square minus 1.7835 square. 19.97 minus 3.18. The whole square root. Do you get the answer as 4.09 over here, friends? Whew. Let's cross check the answer. Did I make a mistake again?
Sir, how we got this total risk, sir? 4.469.
Total risk is we did it using Markowitz method, right?
Okay.
Right. We'll just cross check the answer now. Okay, we'll take 2 minutes and we'll cross check the entire answer.
Sir, I
Because
think
otherwise,
it's 2.1 because
again?
4.45 is the variance.
Okay.
So we have to take the standard deviation, right?
Okay, this is the variance, is it?
Hmm.
No. This is the 1 minute. That is okay. 2.11. So I made a mistake over here. Thank you for correcting me there. This is 2.11. I wrongly took it as 4.469. So if this is 2.11, even this number will change. Here also it will be 2.11. So 4.45. Okay. I will take it as 4.45 minus 3.18. Then it will get 1.12 will be the final answer here. 1.12. Let us cross check the answer, friends. Let us take and check with the solution one by one and see if we have got the answer correct. Okay, right. Yes. Beta, they have got 1.087. Well, let's take the beta part. Yes. 1.087, that's correct. 0.903, that's also correct. 0.60 is not beta, that's something else. That is the weight, 0.6, 0.2, 1.013. 1.013. We have got the answer, right? Expected return, they have got 12.17. Let's go and check that. Hold on. So they have done the CAPM over here, friends. I have taken it directly. They have done it using CAPM. Okay, so that one part, we have a different answer. Friends, I have told you expected return is actually outcome into probability. But in some cases, you can assume the expected return and CAPM return to be the same in the absence of information. So they have done it using what return? CAPM return is what they have done. I have directly taken the returns that is given in the textbook. Opinion wise, both are correct, but you stick to the study material answer. Okay. Variance. Did we get the variance as 4.8? Let's cross check that part now. Yes, variance we got 4.8. Second one, they got 4.25. They have done it in a different format, but we directly got the answer and 3.1. So we don't need to work it out. Referring the table, these values can be derived as what they are directly telling. Now they are asking the standard deviation of the portfolio 2.11. Standard deviation of the portfolio 2.11. We also got the same answer. Okay. Then they are asking you to find out the systematic risk, unsystematic risk, etc. For A, they have got the answer as 3.663. 1 minute. Hold on. That is the variance what they have got, friends. 3.663 is the variance. If I do 3.663 square root, you will get 1.91. Friends, this is one area where your textbooks create a confusion. They use the word risk, but they calculate the variance. All these are variance, friends. You take the square root of these correctly, you will get the answer that we are also getting over here. All right, friends? Yes. So friends, I believe we are done and we got the same numbers since we have to just convert the square root to check with the numbers that we have got because we have correctly done the risk, but they have done the variance part. All right. Let's go to the next question now. Tokenization. Friends, I'll be covering this on the Saturday theory, tokenization. All right. Even this one I'm covering on the Saturday's theory part. All right, friends. Okay. Now let us go to the next question, question number 4A, bond refunding question. I'll write down question number 4A. Working note number 1, basic data. ABC Limited has 600 million, 12% bond outstanding with 6 years maturity. So I'll write down face value. How much is the face value? 600 million. 1 minute, friends. 600 million. What is the remaining life of the bond? 6 years. We have done exactly the same question in class also, friends. Since the interest rates are falling, ABC is contemplating the refunding of these bonds with a 600 million 6-year bond carrying a coupon rate of how much percentage? 10%. So coupon rate 10%. Issue cost as of now it is 12%. Okay. This is a new. Next I'll write down. Existing coupon is how much? 12%. Old. Okay. Down they have told the issue cost of the new bond will be 12 million. Issue cost is going to be 12 million and the call premium is going to be 4%. Call premium 4% of 600 million, friends. How much is 4% of 600 million? Do you get the answer as 24 million, friends? That is before tax, okay? We have to reduce tax from this. 18 million being unamortized portion of the old bond. So I'll write down unamortized portion is equal to how much? 18 million. The numbers have been changed. They will be written off the moment you are refunding the bond. Tax rate is 30%. Here you have tax rate as 30%. So they are asking you whether I should refund the bond, yes or no. So friends, in order to decide whether I should refund the bond or no, I have to go by 3 types of cash flows. Initial cash flow, in-between cash flow, and what is the last one? Terminal cash flow. So I'll write down the next working note heading. Initial cash flow. initial cash flow. Point number A. So now tell me, initially what is going to happen? You will repay the old bond. For how much? 600. You will receive funds from the new bond. Plus. So friends, what is the net effect over here? 0. Okay. Friends, I'll give you a note over here. Since we are comparing old versus new, 600 million is not relevant at the beginning as well as at the end. Friends, this 600 million is not relevant at all. What are we trying to do over here? We are trying to compare the old bond versus the new bond. So when you do that, the 600 million is not relevant at all. Okay. What is relevant is the other cash flows that are coming in between. Now tell me, what are the other cash flows? Coupon rate 10 and 12 is in between. Issue cost of 12 million. So I'll write down issue cost. That will be 12 million into 0.7. What is the tax rate given in the question,
In between,
friends?
right?
Come again?
This is in between cost.
No. Call premium at the beginning. Issue cost goes at the beginning. Okay. I think I got your point. Issue cost is initial, but the tax advantage you will get every year. 12 will go in year 0 itself. Okay, and then call premium will be after tax. Call premium will be after tax. How much is the call premium? 4%. So that will be 24. So it will be 24 into 0.7.
So shouldn't this be a part of your in-between cash flows?
Which one? Issue cost?
No, the call.
Call premium is paid upfront, right?
Okay, got it.
It's paid upfront itself. All
Got
right.
it. Thank you.
So friends, this issue cost is an outflow. Even this call premium is also an outflow. But now you will get tax advantage on old bond. You have a tax advantage on the old bond. Now tell me, how much will be your tax advantage on the old bond? How much was the unamortized portion? 18. So the entire 18 you can write off, on which you will get 30% tax advantage. So do you get the answer as 5.4 million? This will be your inflow. That's it. So from this, can I go and find out how much is going to be my net inflow over here, friends? 12 is outflow, 16.8 is again outflow, 5.4 is inflow. So 23.4 will be my initial outlay. Okay. Now I will have to give you a note for the issue cost. Issue cost 12 million pays today, but it is amortized over 6 years. So every year I will be getting one tax advantage. So I'll write down the next working note heading. In between cash flow. Okay. First one, what will happen in between is I will have savings in the coupon rate. Earlier I was paying 12, now I am paying 10. So how much percent I am saving? 2% I am saving on how many million? On 600 million. On that, 30% tax advantage also will come. 600 into 2% into 0.7. So do you get the answer as 8.4 million, friends? That is the savings in the coupon. Apart from that, what will happen is amortization of issue cost. So how much is the issue cost that you have over here? Is it 12? 12 million will be apportioned over 6 years. So every year I will get a 30% tax advantage. That will be 0.6 million. This is my inflow. This is also my inflow. All right. Amortization of issue cost has come. Call premium completely gone. Okay. Now, next part is important. Opportunity cost. So friends, what happens in case of opportunity cost over here is that, listen carefully. This is important. This is a tricky part. I have written off 18 million in year 0 itself. Had the conversion not happened, I would have amortized this 18 million over the coming 6 years. So ideally, 18 divided by 6 is equal to how much?
3.
3. 3 million I would have written off every year. On that, I would have got 30% tax advantage, which I don't get it now because I got the entire money in year 0 itself. So 3 into 0.3 when you do, you will get the answer as 0.90 million, which will be your opportunity cost. That will be an outflow. So when I take all these things into consideration, my net inflow will be 8.4 plus 0.6 minus 0.9 will be my inflow. Then I will write down the next working note heading, friends, terminal cash flow. Now, friends, I told you in the end, there's only one payment. That is the 600 million being paid. But is that relevant or not relevant? Not relevant because we are comparing old bond versus the new bond. Even in old bond, I would have paid 600. Even in new bond, I will pay 600. Am I paying anything extra? Zero. If my repayment was 620 million, then I would have paid that 20. Okay. So my terminal cash flow over here will become 0. Now, based on this, I should calculate the NPV. Here, cash flow, discount factor, discounted cash flow. Year 0, what is your investment now? 23.4. Year 1 to 6, how much are you getting over here? 8.10. Discount factor is not given in the question. So we will take the after-tax market rate. Market rate is now 10%. So my after-tax rate will be how much? 7% is nothing but 10% into 0.7. All right. So here it will be 1. We will get 4.91, 23.4, 39.771. You will get the NPV as plus 0.271. Since NPV is positive, we should accept the project. Shall we cross-check the numbers now, friends, with your MTP? Let's pray to God we also get the same answer. Initial outlay, did we get 23.4 million? Yes. In between cash flow, they have got 1 minute, 8.10 million. Perfect. NPV 16. Okay, we got 16, they have got 15.2. That's a rounding of difference. Rest everything is exactly the same. So we have got the same answer what even your books have got it. Have I taken a wrong present value factor?
Yes.
I am making some silly mistakes here and there, friends. Sorry for that.
No problem.
Yes, sir. No problem, sir.
4.76. Thanks for understanding. Back to back working out problems drains a lot of energy. But please keep on correcting me so we'll get the right answers together. Okay. Perfect. So we get 15.156 as the NPV. Is that the same answer even they have got? Yeah, almost the same. So friends, bond should be refunded. Are you all clear? I'll give you 1 minute cool off time. Read through this entire thing. Whatever doubts you have, you can ask me now. Something wrong with the AC here, friends. Just a minute, I'll just come back. Yes, friends, I'm back. Please go through this now. All right. Final NPV. I hope you're all clear with this part, friends. Can I go to the next one now?
Yes, sir.
Perfect. Let's go to the next part. Okay. Okay, so we are done with this problem. Question number 4B, we are not doing, friends. We just did the same question in RTP. Exactly the same thing we just did now. Remains at 1000. False. Purchase a 3 months call. Purchase a 3 months put. It's a straddle. Okay. Ditto same question. So I don't want to waste your time over here. Question number C is a theory problem. Value at risk. Friends, we have already learned the theory for value at risk. VAR will give you how much is the maximum loss that you will be having in one day. Correct? All right. So if the loss, 1 minute, online students, I believe all are clear. Okay, 7% is given in that question, is it? Oh, it's already given here. Okay.
PVF is given.
Even if it's not given, it will be 10% after tax. That's also 7% only. It will come like that always. Okay, right. Fine, friends. Now we will do question number. VAR is the maximum loss you make in one day. And you have confidence level like 99% confidence level, 95% confidence level, etc. etc. Okay. Now, shall we go to question number 5? 5 is a question on business valuation. Okay, let's do this question now. Question 5A. Okay. Following information is given in respect of alpha, which is expected to grow at a rate of 20% for the next 3 years, after which the growth will stabilize at 8%. Revenue is given. Cost of goods sold is given. Okay. So what will you do? Revenue minus cost of goods sold will give you the GP. Minus operating expense will give you the operating profit. From the operating profit, you're supposed to reduce the depreciation. I think that's already reduced, included in operating expense. All right. So what I'll do is first we'll just write down working note number 1 and let us try working out the free cash flow. Year 0. Okay. What is the revenue that you have over here in the year 0? Is it 15,000 crore? 15,000 crore. Cost of goods sold is how much? 6,000 crore. OPEX is 4,500. 4,500. So once you reduce all these things, you will get your profit before tax. That will be 4,500. From this, what we have to reduce? We have to reduce the taxation part, correct? How much is the tax rate given in the question?
30%.
It's given as 30%. So how much is this into 0.3? 1350. So we have to find out the profit after tax. So that will turn out to be how much? 3150 will be the PAT. Here, what are we supposed to do? Add back depreciation. Okay, so how much is the depreciation? We will have to work it out. Depreciation will grow at 15%. Have they told anything about depreciation? 1,200 crore. So here the depreciation will be add back 1,200 crore less capex less additional working capital. So less capex will be how much? That also is given over here, 1,500 crore. Okay, and
So
what
can
else have
we-
they given?
So capex is, oh, sorry.
Capex is?
No, I thought capex was including depreciation. My mistake.
No,
Sorry.
no, 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 no. And then they have told capex 4 years. Working capital is going to be 25% of revenue. So here the revenue is 15,000 into 0.25. So you will get the answer as 3750. This will give you the free cash flow. Friends, year 0 free cash flow is not relevant. Only from year 1 it is relevant, friends. All right. Then I have to increase this at how much percentage? I have to grow this at 20%. Capex net of depreciation will grow at how much percentage? 15%. So basically Capex also will grow at 15. Depreciation also will grow at 15%. From year 4 onwards, normal growth will grow at 8%. Incremental Capex will be offset by way of depreciation. So here in the 4th year, we will make it 0 and 0. Okay. During both high growth phase and normal growth phase, working capital is going to be 25%. All right. Friends, remaining part of the table, we have to just project it. So here you will get 18,000. Then you will get 21,600. 25,920. And from here, it will be 8%. 27,933.993.6. So like this, your PBT, your PAT will also grow in the same proportion. Okay, so I'll put 1.20% for 3 years, right? Correct? Per annum, and after that, it will be 4th year onwards, 8%. So what I did is correct. So it will be 1.2 into 3150, 4536, and then into 8%. That will turn out to be 5878. Okay. Depreciation also, they have told the same thing. 144, sorry, 1440. 1728, 2073.6, and this will be not applicable. 1800, 2160,
Excuse me, sir.
2592, last year will be not applicable. Okay. Depreciation,
The depreciation would grow at 15%.
have they told like that in the question? Hold on. What about capex?
That also 15.
Okay, both will be
Capital
15%.
expenditure net of depreciation will go.
Both are 15%. Thank you for correcting me there. Okay. So net of depreciation would mean you are getting the net as 500. Am I right? So here it will become 575. No, it's 300. Am I right?
300.
That is 300. So this will become 345.
So it will all be negative, right?
Negative, because capex is more than depreciation, right?
Yeah. Got it. Thank you.
0.26. Okay. And working capital is going to grow at 20%. So it will be 18,000 minus 15,000 into 0.25. It will be 750 over here. Then it will again be 1.2 only. It will be 900 here. 1080. And the last one would be 27,993.6 minus 25 into 0.25 will be 518.4. 0.40. And from this, we should be finding our free cash flows. Minus 345 minus 750. 2685. 323. 3240. 3906. 5360. These are supposed to be your free cash flows. Shall we cross check whether I have done some mistake over here? Just check. 2685, that's correct. 3240 is correct. 3906, perfect. We have got the free cash flows, friends. So once I get the free cash flow, next part for us to do will be to calculate the WACC, weighted average cost of capital. So for that, in the question, they would have given you the KE and KD. 60% is equity, 40% is debt. KE is 17.53, KD is also given. So 17.53 into 0.4, sorry, 0.6 is equity, right? Plus 16% is pre-tax. So post-tax will be 11.2. 11.2 into 0.4. All right. 10.518 plus 4.48. Do you get the answer as 15% as the WACC? So once you get the WACC, now we need to go and find out the value of the business. So we will do it using two-stage dividend discount model. Stage 1, present value of high growth cash flows. So how do you do that here? Cash flow, discount factor, discounted cash flow. Now tell me year 1, what is the cash flow that we have got? 2685, right? That is the first year, correct? 2685. Year 2 will be how much? 3239. Year 3 will be how much? 3906. And year 4 will go towards perpetuity. Stage 2, present value of perpetual cash flow. So P3 will be equal to cash flow 4 minus WACC divided by G. So cash flow 4 is going to be how much over here? 5360 divided by 15% minus you have a stable growth rate of 8%. So do you get the answer as 76,571? This will come over here as year 3. And we will use the same discounting factor again. Friends, if I'm doing any arithmetic error, let me know. 0.756, 0.657, and 0.657. 2333, 2448, 2566, 50307. I'll get the value as 57,654. Shall we cross check? Yes, they have got 57,701. That's just a rounding of error, friends. We have got 57,654. Hence, the value is nothing but present value of future cash flows. Please go through it, friends. 1 minute cool off time. Beautiful question. I'll get some water and come back, friends. Just go through this. Or wait. I think after I show you this next question, when you read through it, I'll fill some water and come back. Back 15%. Value of business. Present value of stable cash flow and present value of perpetual cash. Sorry, present value of high growth cash flow and present value of perpetual cash flow. Perfect. So we are done with this question also. Next question is a question on perfect hedging using beta. It's an easy problem. Can you try doing this yourself? I'll give you some time. I'll fill water and come back in the meanwhile. Yeah, this is also easy. This is a good problem. We have only 3 more questions to go ahead, friends. Please do this. I'll give you 5 minutes time. Yes, friends. Can we do it together now? All right. So I'll write down over here. We are doing question number 5B. Friends, this is also a study material problem. I have done this in my regular class, and I think in Chennai also I did this question. Chennai or some other place I have done it. I'm not able to recall where. A trader is having a portfolio of 170 lakhs and cash of 30 lakhs. So particulars, amount. Tell me, friends, what is the amount of portfolio? 170 lakhs. What is the amount of cash? 30 lakhs. So what is the total that you have over here? 200. They have given you the beta also. The beta for the portfolio is 1.60. Cash is going to be 0. So the weights will turn out to be 170 by 200. You get 85% weight over here. And then here it will be 15%. I can find out the overall beta including cash now. That will be 1.36 and 0. This is the overall beta. Beta overall including cash. This is the beta of portfolio alone. All right, friends. So now what they are trying to ask over here is that after we find out this, they are saying the current portfolio beta. I think we got the answer for the current portfolio beta as 1.36. Now they are saying portfolio beta after 3 months. If the trader on the current date goes for long position on 200 lakh Nifty future, and after 3 months, the price of the share is dropped by 3.2. Portfolio beta after 3 months, if the trader on the current date goes for a long position. Okay, let us just understand the question. So I'll write down analysis of requirement 2. So there they have told portfolio beta after 3 months if trader on the current date goes for long position on 200 lakhs. So long on 200 lakhs of Nifty future. Okay. And after 3 months, the price of the share drops by 3.2%. After 3 months, price of share drops by how much percentage? It drops by 3.20%. Friends, this answer is a little tricky in the way your textbooks have done it. Let us discuss and do this together now. All right. So first, what I will do, based on this, I will just create a spot and future position. Let us understand what is your spot position, and also let us understand what is your future position. So in the spot, and here you have future. In the spot, I am long for a value of how much? 170 lakhs. Correct? In future, I am short for a value of how much? I'm long again. I'm not short. I'm going to be long over here again. I'm going to be long over here. Come again. Long. Long for 200 lakhs. Am I right? Guru Nirupama, for hedging purpose, I can be short on spot. But here, the question itself says, I am already having a portfolio of 170 lakhs. That means I have bought the share. Buying the share is nothing but long. Am I right? This stock has a beta of 1.6. Now they are saying that price of the share is going to drop by 3.2%. So it is going to fall by 3.2%. So you will sell at this price and you are going to make a loss over here. Now, if you go long over here, if it's falling by 3.2, this has got a beta of 1.6. What will be the fall in the market for every 1% fall here, 1.6 fall over here. So 3.2 divided by 1.6. Here you will have a fall of how much percentage? 2%. Am I right? So you will cancel this position at what price? 200 minus 2%. 196 lakhs. And you will make a gain of how much over here, friends? You will make a gain of 4 lakhs. I'll give you a minute's time. Can you read and understand this part?
So how is that a gain?
Sorry, it's a loss here. Thanks
Okay.
for correcting me there. I thought it's short. This is also a loss, that is also a loss. Both are in a total loss situation. But they are not asking for a loss. They're asking over here is something else. They're asking for the beta. So just understand this, then I'll explain to you how beta calculation is also done. All right. Here it will be 2%. I hope you understood how this 2% has come up, correct?
Yes, sir.
All right, friends. Now, next part is important. Okay. Listen very, very carefully. Shall we do it? Okay. They want to find out the beta. We know the formula for beta is what? Formula 4 is what? Change in the spot divided by change in the market. Am I right? Correct. So I need to go step by step. Step number 1, I need to find out the change in the spot market. So here what happens is, as of now, okay, what will be my revised portfolio value? How much is going to be my revised portfolio value? I think I got the number as 164.56. Correct. Point number B, I need to find out my revised cash. Earlier, how much cash I was having with me? Was it 30
30
lakhs?
lakhs.
Now I have made a loss in the future of 4 lakhs. That loss is real or imaginary?
Yeah.
It is real. So basically what will happen? This is real loss. My cash balance will decrease. In reality, my margin account will decrease, but in this question, they're showing it as if your cash balance will decrease. So now tell me what will be your balance money over here? Will it be 26 lakhs? Am I right? Okay. So now tell me, once I take up these two, what will be my total revised value? I get the answer as 190.56 lakhs. Correct? Okay. Then I'll write down. Okay. Portfolio value at the beginning. So now tell me, initially when we started off, what was the portfolio value we had? 200 lakhs, correct? So from 200 lakhs, it has fallen down to 190. So percentage fall in the spot. So from 200 it has fallen down to 190.56. Is it falling by 4.72%? Am I right? Now, how much has the market fallen by? Market has fallen by 2%. So I'll write down percentage fall in the market. That we just found out it is falling by 2%. Therefore, my beta will be 4.72 divided by 2. Do you get the answer as 2.36? This is the portfolio beta. A slightly different way of working out, friends. I'll give you a minute's time. Read through this, understand this part.
But I have a doubt.
Come again.
I have a doubt, sir.
Tell me, Sarvamangala.
Sir, when we are considering the revised cash, we
Yeah,
have taken 4 lakhs, right? We've subtracted 4 lakhs from 30 lakhs.
correct.
So, I mean, what about the loss in the spot, sir? Like 5.44 lakhs is a loss in spot, right? So we
That's
wouldn't
considered
consider
over
that.
here. We have taken, when we take this 164.54 by itself, we have considered the loss in the spot also.
Okay.
Share value falls down. So that is coming over
Right.
here. Cash
Okay.
value comes down with the cash balance minus whatever money is required in the future.
Okay. Got it. Since the long and short is imaginary in the future, the loss is the only real thing. So that's why we
Yes,
subtracted
correct.
cash.
Correct.
Got it. Thank you, sir.
Friend, there is one more way actually. Okay, this is one opinion. There is one more opinion. I'll just share that also with you. Textbooks
Okay.
have done like this. The other opinion is they're asking you to find out the portfolio beta. Am I right? So what
Hmm.
happens is now you have portfolio and your portfolio value is actually how much? 164.56. Cash. How much is your cash? 26.
26.
What is your total now?
90.56.
190.56. We can find out the weights over here. 164.56 divided by, is it 86.35%?
Yes, sir.
Okay.
Cash is
Other one is going to be
14.64.
13.65%. All right. Now, here we need to work out the beta we already know. For the portfolio, the beta is 1.6 and the other one is
0.
0. Am I right?
Hmm.
If I do it like this, I will get 1.38 and 0. My overall beta will be 1.38. But
1.38.
like this, you get 2.36. This is alternative opinion.
Okay, sir.
This is also correct. But don't use this in exam. Okay. ICA has not used this.
Okay, sir.
So I hope you are all clear with what are the different ways in which we can work out the same problem, friends. Okay.
Thank you, sir.
All right. Can I go to the next question now? Yes. Let's go to the next question. Question number 6A. AIC generic swap. A very, very easy problem. Exactly the same thing is done in our class also. Friends, MTP has taken all questions from my book only, friends. We will now do question number 6A. Working note number 1. Basic data. Okay, so here they have told they are entering into an all-in cost generic swap at 8% against 6 months MIBOR flat. So how much is a fixed rate? 8%. How much is a floating rate? Whatever is the MIBOR will be the floating rate. Okay, and the notional amount is 10 lakhs. In my book, it is 100 lakhs. They have reduced it to 10 lakhs. Semi-annual fixed payment. So I'll write down working note number 2. Semi-annual payment. So here fixed payment is first what we are trying to find out. So what is the formula? Notional amount into all-in cost into 6 divided by 12, or it will be 180 divided by 360 because it's always done on a 30/360 convention. Do I get the answer as 40,000 over here? Next working note will be your floating payment. So now tell me, how will you do this? 10 lakh into, have they given the MIBOR in the question? 6% into 181 divided by 360. 30,166. Okay. Then the last thing what they are asking over here is your net settlement. So that is nothing but fixed minus floating. Do you get the answer as 9834 as a net settlement? We are done with this question also. Let's just cross check with the solution. 2.36 we got, 40,000 we got, 3167, 9833. 1 minute time, read through it, understand. Then we go to the final problem of MTP series 1. I'll just come back in a minute. All right, friends, are you all done with this? Shall we go to the final problem now?
So
Okay, it's a question on certainty equivalent factor. Okay, let's do this. I think even this is done in my class. I'm not sure. Question looks familiar to me. Question number 6B. Working note number 1. Basic data. The textile manufacturing company is considering one of the two mutually exclusive proposals, Project M and N, which requires a cash outlay of 17 lakhs. I'll write down. Outlay in Project M is turning out to be how much? 17 lakhs. Outlay in Project N is turning out to be how much? 16 lakh 50,000. The CE approach is used in incorporating the risk in the capital budgeting decisions, and the current yield in treasury bonds is equal to how much percentage? 6%. Down, they have told the cash flows are given and their CE certainty equivalent factor is given. Friends, they have given you the cash flow and the certainty equivalent factor. They have assumed these to be uncertain cash flows. So when you multiply the uncertain cash flow with the certainty equivalent factor, what will you get over there? You will get the certain cash flow. All right. So now, if you are getting the certain cash flow, then you should discount it using what? Discount it using RF. So we have to decide which project should be accepted. So I'll write down the next working note heading. NPV of Project M.
Excuse me, sir. Previous page, 1 minute, sir. Sorry.
Yeah, take it.
Done, sir. Thank you, sir.
Done? Yes, friends. So here I'll just write down. Here I have 1, 2, 3. Uncertain cash flow is 9 lakh, 10 lakh, 10 lakh. Certainty equivalent factor is 0.8, 0.7, 0.5. From this, you will get the certain cash flow. That will be 7.2, 7, and 5. Now you will use a discount factor at how much percentage? 6%. That is the RF. Certain cash flows are discounted at the risk-free rate. 0.943, 0.889, 0.839. Friends, I forgot to put year 0 cash flow. I'm putting it in the end. You please put in the beginning, okay? Minus 17. So here there is no certainty equivalent factor because it's an assured money going. So that will be taken just like that. So 7.2 into 0.943 will be 6.789. 6.223. 4.195 minus 17. So you'll get the NPV as 0.207 plus. All right. Let's cross check with your suggested answers. 21,960. We got 0.207, 20,700. Now, same way, I will have to go and do NPV of project N. Here, uncertain cash flow, certainty equivalent factor, discount factor, and discounted cash flow. Okay, here I will first put year 0. Year 0, 1, 2, and 3. So year 0, you're investing 16.50. Year number 1, 9, 9, 10. And the certainty equivalent factor is 0.9, 0.8, 0.7. Sorry. Point 0.9, 0.8, 0.7. And here it will be 1. 16.5, 8.1, 7.2, 7. Point 943, 0.889, 0.839. $7.63. 6.40. 5.873. Do you get the answer as 3.403 over here as a plus? So tell me which is the better one, friends. Project N is better or M is better? M is better. Let's cross check. 3,42,000. N is higher, so N should be accepted. So we have got the answer for this one. Now we have a final requirement. If RADR method is used, which project will have a higher discount factor? Friends, when you see 0.9, 0.8, 0.7 means, what is the formula for certainty equivalent factor? Certain cash flow divided by uncertain cash flow. Okay. So for every 1 rupee of uncertain cash flow, you have 0.8 of certain cash flow. Here for every 1 rupee of uncertain cash flow, you have 0.9 of certain cash flow. So this is much more relaxed. This is having a higher risk. So here you should be having a higher RADR. So you can learn it like this. Lower the certainty equivalent factor, higher will be the RADR. I'll give you this in writing over there. Let's confirm with the solution also. Project M is lower, hence M is riskier than N, hence higher the risk area, higher will be the same thing. Okay, so you can just write down one note below so you don't forget. Lower the CEF, higher the RADR. Friends, with this, we are done with this question also, and we are done with MTP series number 1. Friends, we have done quite a lot of problems today. We started with the RTP. We covered all the RTP problems and we did all the MTP. By now, one thing what you would have observed is that if you have already attended my regular class or my crash, most of the questions are covered there only, friends. I think 1 or 2 will be left out, which we haven't done. Even MTP series 2. I'll just quickly show you what is MTP series 2. And you will yourself tell me that if you are, done my problems twice as I have told you, you will be able to remember it. Friends, look at this question. Alpha, beta, gamma. We did this now. EVA, economic value added, exact same question. We industry average, P ratio 11x. Same thing it has come as an MCQ. We did this now. This is a good question. Early cancellation. We have done this in my class, but we will have to do this again. Case scenario 2 is new. We'll do this on Saturday. This is a very good new question. Case scenario 3, multilateral netting. I have only taken theory in the class, but you have got a new question. So this is important. Mark it as important. We'll do this on Saturday. Okay. But remaining, if you see this one, look at this. Exactly the same thing like what we did today. Okay, option question. This one is a question on share valuation. Gordon's model, D1 divided by KE minus G. This question we have done in my class. It is a cross rate question. Regular class, we have done this. Okay. Repo, bank A repo, already done. Okay. This is a portfolio management question from study material. We have done this. This one, weight of X, Y, Z, portfolio A, minimum variance sec. I don't know if you remember it. We have done this. Okay. Blockchain, again, a very good theory question, friends, that's coming in the new syllabus. We will discuss that on Saturday. This question I have given as homework for the class students done in the regular class. Same thing, CAPM. XYZ hedge fund, 40 crore, 0.1% portfolio asset, fund manager's salary. CA is a fund manager. We have done this. TINC, this is a restructuring problem. We have done this in class. Mutual fund, plan D, plan B, already done. This question, sensitivity analysis, we have done this. In sensitivity analysis, we have done this. Plain vanilla swap, 20 crore. Same question done in class. Answer is also given. So friends, already all these questions are covered, friends. 2 questions, I think 2 or 3 at the beginning we saw, which were new. Rest, everything is already covered for you, friends. So nothing to worry. Just giving your best. I will also be working with you. Saturday, we'll have one more marathon session. And then you are having 3 mock tests, 3 MCQs. By the time you do this, friends, nothing beyond this will come in the exam. Okay. Just give in your best and keep working out. Any doubts you have, message me. I will be there supporting you throughout. All right. Thank you so much, friends. Have a nice time ahead. I will share the notes with all of you right away now after I pack up my class. Okay. Thanks a lot, friends. Take care. Study well.
Thank you, sir.
Thank you, sir.